Hello and welcome to our weekly email newsletter. This time, as you notice, I'm going to try and shake it up a little bit and deliver via video instead of the written word, just as a means to kind of try and keep things interesting. I personally think that I've got a face for radio versus TV, but at the end of the day, our social media and our website people believe that the trend right now is to consume information via video. So we'll honor them through that. Right now, we find ourselves firmly rooted in about halfway through the year. So I'd like to reflect back on where we have been, where we're currently at, and where we think we're going. In the beginning of the year, as many people may or may not remember, we came into the year from 2013, which is a very strong year in the equities market, with growing concerns about the change in the Federal Reserve Chairman. Pamela Yellen actually was the first ever woman to hold the chair, which is a great honor, but also came with a lot of intense scrutiny. And our concerns about the path and pattern of reducing the stimulus money, as well as her approach to interest rates. We had mingled in there concerns and issues about Obamacare, the Healthcare Reform Act, as well as you know. Approaching a level in the market where we sorely needed and were desperate for a correction, which actually unfolded in late January of 2014. After that correction, the market has been on a tear and a rally since then, and really has pretty much ignored most of the economic data that has come out in the news on a regular basis. Some of that data has been positive, some of that data not so positive, but the market seems to continue to overlook that, not pay it much mind, and continue to rally. We've seen a reduction in the volume that has normally accompanied the market with institutional traders. And us personally, we've also seen the ability to buy and sell many of the same stocks at a renewed profit multiple times since the fourth quarter of 2013. So that's been positive for our client base. We are going into, back in February, I thought that the market was going to correct, or was in a very good position to correct in a significant manner. So we made some changes to go from moderate growth to more of a defensive moderate position in an attempt to reduce the risk to portfolios, to reduce the volatility involved in our portfolios, while not being schizophrenic in our approach to the markets. So far, that has proved out to be the right move, since the general moderate / growth orientation in the markets proved out to be roughly about 7% return, while our moderate defensive portfolios have proved out to be a tad bit over 5% rate of return. So for a 60% discount in terms of risk in the markets, when you compare the two beta measurements between the S&P 500, which has a beta of 1.00 or 100, and the moderate defensive portfolios we have in place that has a beta of approximately 38 to 40, that would be what I would consider to be a home run in terms of risk versus reward analysis. Does that mean that we maintain that stance between now and eternity? Of course not. That just means that given our position in the market, given our attempt to remain rooted in reality versus what we hope to see or plan to see that may or may not come to fruition, we just need to make sure that our portfolios represent the best information that we know to be true. And so far, they have been. So pretty excited about that. Since 2014, we've also seen a continuation of the increase in clients that have chosen to hire us, as well as assets under management that continue to flow into the firm. And to that, we feel very blessed and very excited. But also on the flip side of that equation, we have seen the need to expand Summit and its infrastructure to support the fiduciary requirements and the continue to support the trust and the confidence that our clients place in us. So to that extent, we have hired Shauna Huberts in the customer service type of realm, as well as Rudy Tallman as a junior advisor to myself. As he passes his exams and becomes more experienced in the nature of the markets, and his expertise grows, we will begin to spotlight him more and more to that extent. We are also very excited to expand our efforts away from Lafayette, Indiana, into North Carolina, and have reached a relationship with a gentleman, Jim Boudreau, and we're very excited as a new advisor with us down in North Carolina. He's going to be focusing his time and his talents and his efforts on North Carolina State as well as UNC Chapel Hill. So once again, very excited to have him on board. Very excited to have Rudy come on board, and Shauna to help balance the workload and the increased efforts and responsibilities we have to all of you, our clientele. I would absolutely be remiss if I didn't say how much I appreciate Nancy Loy and all of her efforts, as well as John Kalunas, Don Carlson, which are equity owners in Regal, which is our back office. Also expressly wanted to say sincerely with gratitude for my coaches, Herm Hefner and John Kalunas, as well as Brian Blodgett and Paul Hamacher, that have been instrumental in providing us services, support, and tools in which we use every day to provide the support, effort, and productivity for clients in their investments. So with that being said, I've done enough for the weekly email newsletter in terms of speaking. So you guys are able to enjoy your week, make it a productive weekend, get out there and enjoy your local community or county fair. And we'll talk to you again next week. Take care. Bye-bye.